Several central banks such as ECB, the Fed, BOE, and also the Swiss central bank raised their benchmark interest rates by 50 bips. So how investors see the impact of those central banks' policy on the capital market and financial market?
Well, the market sold off immediately following the Fed's press conference. It certainly didn't like it. But the first move in equities following an FOMC meeting is often the wrong move. They pushed the terminal rate from 4.6% to 5.1% with their dot plot and with their forward guidance, and the market didn't like that. That's what caused the market to sell off. So I think when you look at all of the conditions, the market didn't actually believe the Fed because the two-year yield closed the week at 4.18%. That's below the Fed funds rate, which is now 4.25 to 5%. And then you also saw the 10-year yield was down to 3.48% closed the week. So it's actually pricing in a possible slowdown from all the tightening that we've seen over the last 9 months. So I think when you put everything into perspective, Sasa, we saw the CPI, the inflation print, come in at just 0.1% month on month. If inflation continues to trend like that, by May of next year, our headline inflation could be below 3%. And I think the market is starting to sniff that out. And even though the Fed is being very aggressive and very hawkish with their talk, as you can see from the bond market's not believing it. And as a result, we think that moving forward, we may have a maximum of one more rate hike in February of 25 basis points, and then they'll hit the pause button. That's the good news. The bad news, Sasha, is that they're not going to give us notice ahead of time. They're not going to say, we may pause after February. They're going to continue to talk hawkish moving forward because they want to bring down long-term inflation expectations. And they've been very, very successful in doing that. If you look at the 5-year inflation break-evens, they're currently below May 2018 levels. They closed the week at 2.14%. If you remember, the Fed is always talking about wanting to get to 2% inflation. And in May of 2018, they were 2.16%. So their talk is working. Their hawkishness is working. But I do think that they're going to have to pause in coming months as the data comes in order to maybe navigate us to a soft and shallow landing.
Okay, so the market see the hawkish of central banks and also the terminal rate to 5.1%. And Thomas, some analysts and economists estimate that the increase in the benchmark interest rate is a sign that a global recession imminent. So how far do you see the threat of a global recession in the United States and how it will affect on Indonesia's economy?
Yeah, well, I think, if you look back to the last time we had an inflation scare like this was 1982, and the S&P 500 dropped 27% during that period. Inflation was in double digits. This time, the S&P 500 dropped 25% peak to trough. But here's what happened. Volcker, who was the Fed chair at the time in 1982, was very hawkish. He raised rates very, very quickly, just like we've seen in the last 9 months. But on October 5th, 1982, while inflation was still near 7%, he said the magic 3 words. And he said, we may shift tactics, okay? With no notice, he said that. And within 4 months' time, all of the losses in the S&P 500 were recovered within 4 months, once he made that shift in language. And I think we could start to see that as quickly as February as the data comes in. So the other thing to keep in mind is many analysts and strategists are saying that the stock market is going to go lower. It's going to make a new leg lower because earnings are going to come down because we're going to have a global slowdown. But if you look at the last 6 cycles since 1957, if you believe that's true, if you believe earnings are going to come down another 10 or 20%, historically, the stock market bottoms 6 to 12 months before earnings bottom. And here in the US, with the S&P down 25% peak to trough, the NASDAQ down 35% peak to trough, we believe that the market's already priced in a lot of that slowdown already. So we've been in the market looking for high quality companies that are on sale. As it relates to how that's going to affect Indonesia, I do think that the pathway to a soft landing is narrowing, but still possible if the Fed is wise enough to pause early next year, provided the data over the next 2 months starts to confirm what we're seeing, and that is that inflation is rolling over aggressively, that the economy is slowing, and if they can pull that off, we could see a similar scenario to 1994 to 1995, when they had to tighten pretty aggressively, about 300 basis points in the Fed funds rate, but they realized that they were having the impact that they desired, and they quickly paused. And the moment that they pause, what you see on average is that the 12-month return since 1954, there have been 13 instances. The average 12-month return for the S&P 500 is 14% just 12 months later after they pause. So I think that the other thing that has people a little bit worried about a recession is the guidance that they gave on the unemployment rate. In their forward guidance last week, they expect 4.6% unemployment. We're currently at 3.7%. So what they're effectively saying is they intend to tighten things to a level that another 1.2 million people lose their jobs. I think that's a little bit aggressive, and I think that they'll probably have to pause their activity before reaching that level. So we're hopeful there's still a narrow path for a shallow landing, a soft landing. And if that's the case, I think emerging markets are exceptionally well positioned. The other thing is that as they pause, the dollar is going to continue to come down, which is going to be very, very helpful for emerging markets.